Every major market crash in the last 20 years started with the same warning, and that warning just went off again. In 2025, Big Tech issued roughly $121 billion in bonds to fund the AI build-out. Goldman Sachs expects that number to hit $250 billion this year and roughly $400 billion next year. Corporate bond spreads, the premium lenders charge over government debt, are nearing their tightest levels since 1998, meaning lenders are charging Big Tech barely any more money than they charge the US government, the safest borrower in the world. But here's the catch, that calm might be running out of time. So by the end of this video, I'll show you the opportunities hiding in this story. One that is doing the borrowing because their numbers are simply that good, and one that's getting paid because of it. We've started the video with a claim, but there's an actual pattern here. Go back 20 years, and before every major market crash, a widening of the spreads has occurred. In 2007, I think we all know what that preceded. In the year 2020, it was only a brief moment before the market had actually topped as well, right before the COVID crash. And then there's been the 2022 bear market, where the widening has been happening for a while. The warning has been there, and it did follow. So the premium companies had to pay for their bonds had increased every single time, and whether the projection would have been enough or the spreads would have needed to widen for a few months, it did precede every single major crash. Now before we move on, I do want to make a small disclaimer. Not every single widening has led to a crash. Others have not caused even a substantial decline, some of them only a smaller correction. But the story is important, and here's what that spread actually is in one sentence. It's the market price for risk. A tight spread means that there is low perceived risk. A wide spread, on the opposite, of course, means that the market is getting nervous, that the default risk would increase. So the overall investment grade market is still calm, still historically tight, but underneath that average, hyperscaler spreads specifically have started to widen. And what do you think that means? It means the stress isn't in the credit market, it's in exactly the companies funding AI. In the first part of this year, investor demand for hyperscaler debt outpaced supply by nearly a 5-to-1 ratio. And by July, right now, we just got past July, that ratio had fallen under a 2-to-1. Amazon found out what that means firsthand when it went to sell $25 billion in new bonds. It had to sweeten the deal with extra yield just to get the investors to show up. So here's the loop this video keeps coming back to. The debt is cheap right now, but right now has an expiration date, and the sector itself is what's shortening it. So is this fine or is this a problem? What do you think? Well, collectively, the hyperscalers still generate more cash than they spend. Their 2026 capital expenditure is estimated to be roughly around $750 billion at this point. That against $778 billion in operating cash flow, it fits. Barely, but it fits. Now, here's the catch. Debt issuance is now running at about a third of their capital spending. And that share is projected to grow next year. So the gap isn't closed by cash flow anymore. It's closed by borrowing, and the borrowing is what's getting more expensive. So which side is winning, the bulls or the bears? Well, both of them have to be credited. The bull case, well, the market isn't pricing serious default risk here. And if the lenders thought that this capex spree might not pay off, they demand a much bigger premium. This has not happened. We are still looking at relatively tight spreads, a small premium, and that's a real signal. Now, the bear case, well, capex is running well ahead of proof that AI investment is generating the matching revenue. And cheap debt doesn't mean the spending is justified. It just means it's currently affordable, and those are not the same thing. Both cases can be true at once, and that tension is exactly what the next part of this video is about. So we've been talking about bonds this whole time. Boring, right? But here's the thing. Bonds are the part that you can see. Alongside the bond market, hyperscalers have been funding data centers through joint ventures with private credit firms. The tech company takes a minority stake, signs a long-term lease, and the vehicle raises the debt instead. Meta's Louisiana campus is the template. It sold 80% to Blue Owl, and the joint venture took on $27 billion in debt. Meta leases the site back, keeps operational control, and the debt sits off its balance sheet. Oracle has moved roughly $66 billion this way, and XAI about 20. So how big is this part we can see? Well, bigger than the part we can, interestingly enough. Off-balance sheet commitments across the 5 biggest tech companies now run around $1.65 trillion. And that is more than the $1.35 trillion that we can actually see, that is reported as actual debt. Those commitments have grown roughly 8-fold in 4 years. And I know where your mind just went, because it's where everyone's went. The Enron comparison has been all over financial media this year. But here's the important distinction. And one analyst put it perfectly. Enron's crime wasn't having these SPVs, special purpose vehicles. It was hiding them. Today's structures are legal and disclosed. They're just disclosed as footnotes nobody reads. So the closer parallel is 2008. Not fraud, but complexity. Structures that moved risk off the books, off the people who created it, and onto pension funds, insurers, and private credit. And it's already having real consequences, where S&P downgraded Oracle's credit rating, citing roughly $260 billion in future lease obligations. But what does this mean in relation to everything we just discussed? Well, it changes what a widening spread means. If most of the leverage isn't in the bond market, then the bond market moving at all is telling you that something much larger has already shifted underneath it. So let's go back to the pattern here, because it's worth being precise about what it does and doesn't tell you. Here's what's true. Every major equity drawdown of the last 20 years came with high-yield spreads widening. But here's the catch, and this is where most people get it wrong. We've had major increases, major widenings, that didn't even cause a major crash. In fact, this one in late 2021 had a weaker widening than the 2016 oil crash. So what do you actually do with this? You treat it as a necessary condition for a crash, not a sufficient one. Widening spreads don't tell you a crash is coming, but a crash hasn't arrived without them. It's the smoke you see when something is burning, not the fire itself. And this isn't just hypothetical anymore. Reuters looked at 91 hyperscaler bonds issued this year. 78 of them were trading at higher yields by late July than when they were sold. A median jump of about 22 basis points, so most of this year's deals are already underwater. And I know what you're thinking. He's talking about bonds again and percentages and basis points. When will he get to the stock stuff? I hear you. I promise we will get to that in a moment, but this is actually quite important. Look at where it's concentrated. Median spreads for the big 4 issuers went from 30 to 40 basis points on short-dated debt, 50 to 60 on median debt, and 108 to 118 on 20-year plus debt. But the numbers are not the highlight here. The percentages are. Where the widening is worst at the short end, the opposite of what you'd see if this were a solvency worry. So this is telling us that this is a supply problem, not a credit quality problem. So if the window is still open, where does that show up in an actual portfolio? Starting with the one doing the borrowing. Alphabet, or as most of you know it, Google, one of the biggest issuers in this entire wave, is what I'm looking at. And here's the part that actually makes this a bull case, not just the balance sheet is fine shrug. Google Cloud revenue grew 82% year over year. That is an enormous feat. 24.7 billion last quarter, and its backlog. Contracted future revenue customers have already signed up for a hit 514 billion, up more than 50 billion in a single quarter. That's not capacity being built on faith. That's proof customers are already paying for the infrastructure Alphabet has not even finished building yet. But here's the catch, something we have to acknowledge. Free cash flow actually went negative, about $5.9 billion in the red, because capex accelerated even faster than growth did. But Google is still spending faster than it's converting that demand into cash today. And I won't leave you without an actual setup, of course. So let's look into the actual chart. Google has been one of the best performers in the last year. From its lows in 2025, we're looking at an increase of almost 2x over just over a year. The beautiful part, this structure doesn't seem complete or even close to complete. The momentum still seems to be accelerating, and in my preferred scenario, I believe this would have been only the wave 1 up, this would have been the wave 2 down, and right now, it would still be building the wave 3. Of course, that would be followed by a correction, possibly a more substantial one, a wave 4, and the trend would then continue with a wave 5. And at this point, I'm not even looking at opportunities in terms of the wave 4 and the wave 5 to follow. I'm looking at opportunities in terms of this internal structure, this wave 3. Depending on where I want to consider the wave 1 to have topped, either here or here, I would be looking at an ideal target at the 138.2% extension of the wave 1, and right now, that sits just under $500. And you could argue that we already have a complete pattern within this rally, we already have 5 waves up, but within such a structure, especially within a wave 3, it's actually quite common to see the wave 5 extend. And given the structure we have internally, I believe this wave 1 would have topped somewhere around here, doesn't really matter, it could see even further extensions. And right now, this could have been the wave 5, but at the same time, this wave 5 could notice considerable extensions higher, and we could be looking instead at an internal 5-wave pattern developed to take it to even higher prices. So what am I looking at instead is a 5-wave move up, a 3-wave pattern down, a corrective pattern complete, and a potential bottom to already be had. In this case, I'd be watching for support down to $296.70, where the wave 2 has reached the 61.8% retracement, and it has already taken out the previous swing highs within this supposed wave B. So in that sense, is this breakout confirmed? Unfortunately, not so clearly as we would wish, as within the internal structure, if I am to zoom within the smaller time frame, I can identify this as a wave 1 up, a wave 2 down here, and I could argue that the wave 3 would have topped here, this would have been a wave 4 and a wave 5, but what is probably even more likely is that the wave 3 would have just stopped and the wave 4 would still be ongoing. Now, depending on where I consider the wave 3 to have topped, either here or at the actual top, which is debatable, I would track slightly different levels of support for potential continuation higher. If the wave 3 were to top at the peak, support would only go as low as $356. But as I was saying, within this structure, it is actually quite pertinent to consider that wave 3 would have topped somewhere in this region, in which case support would be moved quite a bit lower and would allow one additional low to be formed internally within something like an A, B, C pattern. This allows a correction as low as $353. Then if this structure generates that one additional high within the wave 5, in either scenario really, we would be looking at an initial 5-wave move to the upside, which allows a high probability setup. A 3-wave correction would be expected into the wave 2 area of support, and then a massive rally to continue this as a large wave 3, where the ideal target of this internal wave 3 is the 138.2% extension of the wave 1, which itself is around $554, much beyond what we would have expected from a large time frame perspective. And that is entirely in play. Could this setup still survive if it sees a break below the 50% retracement here? Well, technically yes, but it would have been heavily damaged, quite weakened. I would have to consider that this would be another one too, and in that case I would actually not even like to see the 50% retracement broken anyway. So the likelihood would remain that only as long as we hold, let's say, $350 around that region, that we can really expect this to be a somewhat reliable structure to still extend higher. A reset within this larger wave 2 would technically remain a possibility, but if we break below the larger support zone, below the 78.6% retracement, we would have to be prepared that a different pattern would have to be tracked for Google. But who is the one that gets paid that caught my attention? That would have to be Intel. So Google and the other hyperscalers are borrowing the money, but they're borrowing them to pay companies like Intel to get the products that would be put into those data centers. And there would be many names that could actually fit this box: Nvidia, TSMC, and really many others. But the most interesting one that I have found, that I consider to have the most clear opportunity, is Intel. It's shown an incredible quarter, with revenue growth being the highest in over 15 years. Data center and AI revenue up 59%, and foundry revenue has increased as well. With the lack of supply, this is going to be critical. Pair that with one of the most clear setups, and we are looking at something that shouldn't have been even possible to go by unnoticed. In the semiconductor sector, the constraint isn't demand, it's supply. Wafers, memory, and packaging capacity are all tight. Even they increased 2026 capex guidance above $20 billion to fix exactly this issue. And this isn't the same Intel we would have been talking about 2 years ago, when your problem is that you can't build fast enough. Well, that's just a different kind of a problem. And the chart, of course, because this is where we get the most evidence that this structure is not done. And even when Intel was trading still in the 20s, we were looking at the trend it was setting, and the ideal target for this move up, this increase, was just under $200. That is the ideal target even today, and we are looking at this pattern to still push into the 138.2% extension of the wave 1. Today, this pattern would still remain incomplete. It would be strongly suggested to us that we would see this continuation higher. Pair that with the current levels trading at just under $100, we would be looking at about a 2x, and the beautiful part, the levels are clear. We are tracking an impulse where, right now, Intel would still be developing its wave 3. It would have something along the idea of a 1, 2, and this being an extended wave 3, we would track internally a 1, 2, 3, 4, and a 5. Within this interpretation, I am looking at Intel to still form one major push higher, even before it tops within its internal wave 3. In this assumption, I consider that the wave 3 would have topped here, and this would be developing as an expanded flat correction, where it appears to have bottomed right into the 38.2% retracement, the ideal target for a wave 4. This wave 4 has a perfect match with this as a wave 2, and the structure down within this correction seems quite complete. We already have a nice bounce from the current lows, but still the same flow we have seen on Google. This is a slightly larger time frame structure, and internal previous highs have not yet been taken, but the pattern does still strongly prefer for the price action to continue higher. I would be looking at this to have been a wave 1 from the lows, a wave 2 would have bottomed here, and the wave 3 would right now still be in development ideally. I'd then be looking for a 4th and a 5th to complete this pattern, and once it's done, we would have an initial 5-wave move to the upside, which suggests with high probability that after a 3-wave correction into an internal area of support, we would be looking for at least another 5-wave move to the upside. That would most likely end up being the actual wave 3, which would be able to take us into the $200 region itself, which, since we are still so far away from having a complete pattern, yeah, we would still be developing right now this as a wave 5 of a wave 3. The larger wave 3 would be expected to far exceed the overall ideal target that sits just under $200. So, given all of this, all we really need to do is identify within a smaller time frame the structure that would allow this setup to be had. So, I'd be watching within this internal wave 3 a 5-wave pattern to be developed, a 1, 2, 3, 4, and a 5. However, the ideal target for this as a larger wave 3 has not yet been reached, so I would primarily expect for the structure to extend even higher. Then, given that this supposed internal wave 5 would be a bit short, I would have to assume at this point that we will see either a reset within this wide wave 4, or this to have been an extension within the wave 3 and only now to build a wave 4. I would ultimately track very similar levels of support anyway, and what I would be watching here is down to the 50% retracement, $96 to be held, where unfortunately if we get a sustained break below that, it is a rather great warning sign that this structure will not actually succeed and we might need to build maybe a different pattern that would still allow extensions higher, but just maybe we would see a failure. At this point, it would still be way too early to tell. I am watching with preference still for extensions higher, and I would be surprised if this wave 3 forms a local top into the structural resistance we have around $107, yes, this previous swing high before the last drop. But if that happens, the ideal target for the wave 3 would have been reached anyway, and we would be able to look for the correction in the wave 4 to still allow this extension higher. Then what I said about Google, the structure allowing a more direct breakout, would be possible if it builds something like a series of 1-2 setups. But it is fragile, and that is always going to be the case with such large amount of 1-2 setups. But these are the levels I'm watching for Intel currently. So what do you think connects Google's borrowing and Intel's earnings bet? Follow the money. The cheap hyperscaler debt funds the capex, which becomes chip orders. The chip orders increase. Chip orders means Intel's numbers go up and this fuels Intel's growth. So every link in this chain actually depends on the first one in the end. So where does this leave us? Broad credit is still calm. The demand behind Google Cloud and Intel is real. The chip rally underneath it is backed by actual earnings, not just hope. But the one thing to take away from all of this is that spreads are widening. On its own, that's happened plenty of times without a crash. So this isn't a prediction, it's a warning. What makes this one different, however, is what's underneath it. In every previous episode, the spread was pricing most of the debt. This time, it isn't. Most of the leverage sits in private credit, in leases, in vehicles the public bond market never sees, so the widening we can measure is the smaller half of the story. And it doesn't need to go far to be telling us something much larger already moved. So keep an eye on it. And this is the story that I'm watching right now. These are the two stocks I'm looking at and considering a great opportunity. If you want even more opportunities, check out the Patreon. But for now, these were the levels. This is the trade setup. I hope you enjoyed the video. And if you did, don't forget to leave a like, subscribe. And if you enjoyed the content and want to support it directly, check out the channel membership. And I'll see you in the next one. Bye bye.